gold has already doubled. So the first double is in the bag. The second double to $8,000 is coming. And then the next double to $16,000 is expected to arrive by the mid-2030s. So over the next 10 years, we expect gold to double and then to double again. That's what this chart is telling us.
You're watching CapitalCOSM. My name is Danny. It is October 9th, 2025, and my guest today is Kevin Wadsworth by way of the North Star Bat Charts website. Kevin, thank you so much for coming on, my friend.
Yeah, I'm flying solo today. My buddy there, Patrick, is busy moving house at the moment, so he's buried under removal boxes and goodness knows what else. So you're stuck with me today, Danny.
Yeah, well, you should be more than enough to be able to guide us through what's going on here, Kevin. Let's go ahead and talk about the big story, which is silver breaking up over $50. And at the time of this recording here on October 9th, silver is at $50, the spot price that is. Futures price actually a little lower, $48.23. So the futures price on silver down 1.5%, while the spot price is actually up 2.7%. So go ahead and walk us through what we're seeing here on silver. What's going on?
Yeah, a lot of volatility, as you might expect, and a lot of backwardation there as well between spot price and the sort of futures contract prices, which is interesting to say the least. I don't know what's going on behind the scenes, but not sure I really want to know, to be honest. But the silver roadmap is playing out pretty well. The roadmap chart that we're looking at the moment there, the cup and handle chart for silver, was the one that we issued back in around about 2019, 2020. And it was blindingly obvious when we got the COVID lows that the most probable outcome was for silver to follow this trajectory back towards the $50 area. That's not just from this chart alone, but it's from a weight of evidence provided by things like the gold to stock market ratios and a whole bunch of other charts that we look at. So we were able to sort of say back then that this was the most likely path, and silver has followed that path. And as you say, it's spot silver anyway has tested and broken through the $50 level today. I don't know where it's going to end up at the end of the day, but in terms of the bigger picture, Danny, $50 is a key psychological level. We've never previously actually been at 50. When we got to the highs in 2011, the spot price there was just a fraction below 50, around about 49.80 something, depending on which exchange you're looking at. And then in 1980, it was what was it on the high there in 1980? It would have been somewhere a little bit below, quite a bit below that $50 level, around about $48. So certainly getting to $50, it's a psychological level. But gold, if I just pop this on the line chart, gold had this same pattern where you had the highs in 1980, the highs in 2011. And then in the case of gold, the red line that you see here cut through the price at around about 27.50. And if you look at the chart for gold, you'll notice that for a couple of months after hitting the red line, it pulled back a little bit and then broke out. And we know what happened after it broke above 27.50. It moved all the way up beyond $4,000 in pretty short order. So the question is, silver, what's silver going to do when it gets to this level? Well, this 55 to 57 area is my sort of short-term target. And we've got a sort of couple of options at that point. Either we pull back and test an area somewhere in the low 40s and then probably move up to the upside, or I think what is quite likely to happen, and it sounds a bit crazy, but I think probably a little bit more likely to happen, is that the euphoria carries the silver price further without much of a pause. Now, this is being recorded and it's probably going to go out in a couple of days' time. I don't know, so I might look very, very silly saying this, but I think the balance of probability is a little bit more on the side of silver breaking through pretty rapidly rather than taking several weeks or a couple of months to break through convincingly. I suspect it may slice through that level rather quicker than it did with gold, and can go on to explain that in a moment why I think that. If it does, if I'm right, and if it does, then I think the target is somewhere close to 100, and it would happen pretty rapidly. Something like that angled trajectory there would probably take it close to $100 by the end of the year, that sort of time. Just to sort of put into context what's going on at the moment, this is the chart which I've just sort of put together today for how things have been moving in 2025, and you can see we've got all the tech stocks on there: Amazon, MicroStrategy, Apple, Meta, Microsoft, Google, Bitcoin as well, Nvidia there, and gold and silver. And if you cast your mind back to back end of last year, Danny, we were talking about capital rotation. Well, we've been talking about capital rotation for a while now, but we've been suggesting that gold and silver are going to increasingly outperform stock markets and increasingly outperform tech stocks. And we've seen that through this year. I think perhaps a lot of people aren't aware of the fact that gold and silver, I mean, silver there plus 60 something percent, completely annihilates most of the tech stocks, which have moved up 10, 15, 20%. MicroStrategy there down a little on the year. So there's something going on here. And if for those of you that follow me, and I'm just going to quickly go onto my my X feed, this is what's going on at the moment. It's a capital rotation process. And for at least a couple of years now, these boxes in this matrix have gradually been turning red, telling us that a capital rotation process is taking place. Gold is in a bull market versus money supply, the US dollar index, so US dollar strength, CPI, PPI, currency in circulation, the equal weighted S&P, the New York Composite, the Dow Jones, the Wilshire and the Russell. So gold is in a bull market versus all of these things, or these things are in a bear market versus gold. The last couple of boxes here are the S&P and the NASDAQ, which are currently moving towards a bear market priced in gold. To confirm the capital rotation event, we need the stock markets to fall significantly. And that's where things start to get complicated, Danny.
Significantly nominally or relative to gold only?
Nominally. We need a nominal significant drop for stock markets. I'm going to try and tie this together for you in a way that hopefully makes some kind of sense. Just looking at silver, and I produced this chart a few weeks ago. We were breaking out above this rising wedge pattern, actually back in August, and I said, well, breaking upwards from a rising wedge means that we are quite likely to see an energetic upside move, because bearish rising wedges, as their name suggests, usually break to the downside. When they don't, it's the market telling you something really important, and that is that the forces that are acting in the market at the moment don't care about bearish rising wedges. They just squeeze the price out of the top and off it goes to the upside. So, you know, the thesis was that if silver broke above that sort of level around 38, then it would experience a rapid upside acceleration, and a kind of a spike move, if you like, a silver spike move, which relates back to that silver volatility chart that I just showed you, because when the silver volatility rises rapidly, it's either doing it because the price of silver is falling fast or it's rising fast, one or the other. So the volatility in the silver price is rapidly increasing at the moment, and because we're in a bull market, and because of that chart I just showed you, we know that it's because the price of silver is escaping to the upside. Another way of looking at that, and another way of confirming it, is silver versus the S&P 500. So a couple of weeks ago, I showed this chart as it was breaking out from this. Well, actually, it's around about a week or so ago, as it's breaking out from this red sort of wedge pattern. And as we closed the week last week, I said that we've got a really good opportunity for silver to move beyond $50 this week. And the reason was because we just squeezed to the upside from this rising wedge, which meant that silver had broken out to the upside versus the S&P. And when silver's moving up versus the S&P, when the S&P is doing okay, then obviously it means silver is doing even more okay. So the technical analysis plus knowing what the S&P chart was doing suggested to me that we were very likely this week to break beyond $50. Now we moved up, we back tested yesterday, and then we've moved up significantly since then. So, that's another piece of confirmation that, silver is in a period of outperformance versus the stock markets, and this kind of idea of rotation away from stock markets towards gold and silver is something to really take note of. So I'm going to start trying to answer the question of where we're going next with this. This gold to silver ratio is what I call a decision aid. When I was working with the military, forecasting meteorological conditions for the Royal Air Force, we use something called decision aids to help them make a simple decision. They don't want a complicated weather forecast. All they want to know is can they complete the mission that they want to do on that particular day. So, we don't want to sort of give a particularly messy answer to the question: is gold going to underperform or outperform silver? And this support line, this lower support line here, what I've been saying is that when we break down into this green zone, it's what I would call the main event. Something major is happening when we break down, and silver is outperforming gold to the extent that it's broken long-term support. This is a monthly chart, so we need monthly confirmation of this breakdown. We could close the month back above that support line. So, this is very much kind of looking forwards to the end of the month and assuming that we are still below the support line and in the green zone. If we are, then this is what I think is going to happen. I mean, if we're not, then it's likely that gold and silver sort of experience a consolidation or a pullback, because that would imply that the gold silver ratio is going upwards, which implies that gold is doing better than silver. That usually happens when there's a pullback going on, or at least at this stage, that's probably what it would mean. But anyway, we'll just assume that we're still below the line at the end of the month. Then what I think is going to happen is that we're going to have a period of outperformance, probably down to, I don't know, maybe somewhere around the high 60s. Somewhere you see this black level here in February 2021, and this level over here in 2017. Somewhere in that sort of zone, there's some support. So we would probably see the ratio dropping quite quickly to that level, and then I think back testing before going lower. And that would be, so I'll just make that a little bit clearer, because the line is a bit, if I make it black, you might be able to see it.
And
So,
of course, this is the gold to silver ratio, which would a downside move would imply an overperformance of silver relative to gold. But even if that may be the case, this isn't taking into account gold's price move, whether it be up or down. It's just from a relative standpoint.
It's from a relative standpoint. So silver doesn't really tend to outperform gold unless the metals are doing well and going up. When the metals are losing value, silver underperforms gold. It's more volatile in both directions. As we're seeing now, the prices of gold and silver are going up, but that chart that I showed you just now shows that this year silver has moved up more than gold. So when they're doing well, particularly at this sort of stage in the game where silver is experiencing a spike upside move, then silver will rapidly outperform gold by virtue of the fact that it's a smaller market, I suppose. It doesn't take very much investment coming to the silver space to make it go up 20 or 30% in comparative terms to gold. To shift the gold market by 20 or 30% is a lot harder. So it's that simple dynamic. Just sort of zooming out a little bit and kind of considering what's going on from the bigger picture, and we've shown this chart to your viewers quite a few times, Danny, is the Dow to gold ratio. The Dow to gold ratio has very clearly, decisively broken down into a bear market. So whatever happens over the next several years in terms of this chart sort of moving back to the upside a little bit, and the Dow outperforming gold for a little while, you get corrections along the way, but we are below long-term moving averages. And I've got the for some reason I've got the 32 quarter moving average on there, but you can see that it's actually the 8 year. It is actually the 8 year moving average. That's why I've got it on there. So gold has an 8 year cycle. We've got the 8 year moving average on there. And when this ratio is below the 8 year moving average and below the Ichimoku cloud and breaks below support lines, then you're in a bear market for this ratio. This ratio in a bear market means the Dow Jones is underperforming gold. And that puts gold in a bull era. Each time it does that, in the 1930s, the 1970s, and the 2000s, that's when gold doubles, and then it doubles again, and then it doubles again. Well, we've already doubled. I mean, I've been saying this, for the last sort of 18 months, 2 years, and from when gold was below $2,000, and we started showing these sorts of charts, gold has already doubled. So the first double is in the bag. The second double to $8,000 is coming, and then the next double to $16,000 is expected to arrive by the mid-2030s. So over the next 10 years, we expect gold to double and then to double again. That's what this chart is telling us.
So when does the next double from here arrive?
So putting that, okay, I probably need to go into a couple of other charts to explain that, but I think from here, somewhere in the sort of 4,200, 4,300 is a resistance area for gold, but a lot of this is going to depend on when the stock market breaks down, because when the stock market breaks down, I suspect the precious metals will at least pause for a period of several months, and quite possibly correct for a good period of time. So let's assume we get to, let's say, $4,500 or $5,000. A pullback to $3,500 or $4,000 is entirely plausible, and historically speaking, that would be entirely in line with what has happened historically. So you can imagine if we get to $4,500 or $5,000, everybody's going to be looking upwards towards 10,000 or something silly, but ignoring the fact that completely ignoring the fact about how stretched gold is in terms of its metrics and what is likely to happen in a stock market correction, and also what all of these ratio charts are saying. So a pullback to $3,500 or $4,000 at that point would be highly likely, before then moving beyond $5,000, $6,000. So to answer your question, I don't think we're going to see a doubling to 8,000 for a few years. Probably 3 to 5 years. I think we have to go through a significant drawdown first, perhaps to $3,500 or $4,000 from wherever we get to, and then from there, from $3,500 or $4,000, we start going back up over the sort of year or two after that to sort of 5, 6, 7, 8, and then we've got an 8 year cycle low to think about, somewhere around 2029, 2030. And then the final sort of push of this bull era, which should see the final doubling, will happen, I think, between 2030 and 2035. So during that 5 year time frame, that's where you get the sort of final, I think, the final sort of move in this bull era. That's the roadmap at the moment, anyway, Danny. But something that's really interesting for silver, and this is circling back to silver, is the idea of what me and Patrick have started to call a super CRE event, a super capital rotation event. So by this definition, the event in 1930-31 was a regular capital rotation event that led to, so this is the S&P versus silver ratio chart, and we got over a long period of time, we got a very clear support line which defined what we're calling a super capital rotation event that actually took place in the 1970s, and that's when the pegging of gold was removed, and silver, which hadn't been pegged. This is why we're looking at silver, because it avoids the issues that you have with the gold peg. the ratio dropped really, really far and really, really, really fast, very quickly. And that means silver massively outperformed the stock markets in a way that only happens when you break these multi-decade support lines. And look what's happened. If you just look at the fractal that's taken place here, the move from 1920 to sort of 1930, we've seen that sort of move all the way up to the year 2000 there, and then the drop to the support line below the Ichimoku cloud and the moving average, and then the sort of insipid recovery where we make a lower high, same as the recovery that took place in the 1950s and 60s here. And there was a similar dynamic going on here with the 10-year yields. The 10-year yield broke out in the 1950s and 60s. And so the debt dynamics underpinning all of this were quite similar. But just look what happened when this ratio broke down. And if I add the silver price chart to this, it's going to probably be quite revealing for you to see. I'll just put this on a log scale. So what happened when it broke down? When this ratio broke down here in 1967, I'm just going to move that line back to 1967. The price of silver surged, and it pretty much doubled as this broke down. I'll zoom in a little bit more so it's perhaps a little bit clearer. I'll just move that red line. So you get the breakdown on this ratio here. Get this 1, 2, 3, and breakdown. Fast forward to today, 1, 2, 3, breakdown. So silver surged as the S&P to silver ratio dropped. And if I just move the red line along a little bit, the price of silver peaked when this ratio hit the super CRE line, and silver started to correct as the ratio bounced up. Okay. And it wasn't until, in this case, a couple of years later, that the ratio really, or 2 or 3 years later, that the ratio really started to plummet again, and the price of silver in US dollars really started to accelerate to the upside. So what I'll say to people watching this is that when this ratio, let's assume for a moment that the ratio does hit this super CRE line, that would be my exit point for my silver positions. At that stage, silver's probably going to be close to $100. Bearing in mind, I took my position somewhere around $20. That's a 5 times move, and I'll be quite happy to step aside at that point and just let this play out. If we actually start to break down below that super CRE line, then there's plenty of time to retake positions and get back in. You know, after such a huge gain, there's no issue with rejoining the party after that confirmation breakdown. But it's highly likely, in my view, that when we hit that line, the price of silver hibernates. It might not be for 2 or 3 years as it was in this period, 1967 to 1970, or in fact, it even went on beyond that, didn't it? The price of silver there peaked. Let me just move that line back in 68, and it took off again in 72, 71, 72. So there's a long period there where silver didn't really do very much, and then it went ballistic again. I'll just add the S&P chart on for you. Some people are probably thinking.
So just really quick, Kevin, really quick. If we're to anticipate 2 more doublings on the part of gold from 4 to 8,000 and 8 to 16,000 over the course of 10 years, wouldn't we also anticipate a similar move for silver as well?
More than that, yes. So silver would more than double and double again. So from $50, well, okay, let's say the first double is from 50 to 100, if that's what happens. I mean, all we've done so far is get back to the previous all-time highs, which we were at in 1980, and we're just breaking as we're breaking below the support line. We are now crossing the $50 threshold. So 50 to 100 would be your first double, 100 to 200 would be your next, and 2 to 4 would be your next, and then beyond that, so $500, $600, $700 is not outside the realms of possibility. It sounds crazy, but those sort of percentage moves are what silver has done in the past. I mean, silver moved from $4 to roughly $50, and nobody seemed to sort of bat an eyelid. So it's perfectly capable of making those kind of moves, and guiding us along the way will be this chart and the gold to silver ratio chart. The stock market, I think this is quite important, because in the 1970s, I'm just going to expand this up a little bit. This green line is the S&P 500, and we had a drop from around about, what was it, 100 or so down to 75, about a 25% drop, and then the S&P recovered, and then it dropped closer to sort of 50%, I think, something like that. So there's a wave of small drop, recovery, larger drop, recovery, big drop, recovery, went along for a few years, and then eventually started to break to new all-time highs. It wasn't until 1982, 83 that the S&P 500 actually went on into a proper bull run and broke to new highs. So all the way from the late 60s, early 70s, all the way to the early 80s, the stock markets were pretty much dead money. And that would be, a likely scenario for what comes next.
All right, guys, quick break from the video because I've got to tell you something pretty wild happening in the Dogecoin world. You've probably heard the jokes, Doge is just a meme coin, blah, blah, blah. Well, not anymore, because House of Doge, ticker symbol TBH on the NASDAQ, is the official corporate arm of the Dogecoin Foundation, and they're taking Doge mainstream in a big way. They're the team building out the real utility. So think payments, tokenization, merchant integrations, even education for new users. Basically, all the stuff that turns Dogecoin from just internet culture to something businesses and institutions can actually use. So they partnered up with CleanCore and the official Dogecoin treasury, which is fully transparent and professionally custodied on Bitstamp by Robinhood. This is the first and only foundation-backed Dogecoin treasury, and it's literally Dogecoin planting its flag on Wall Street. They've already stacked up over 600 million Doge, and they're racing towards 1 billion tokens. So this is real execution, not just hype. So if you want to keep an eye on how Dogecoin's evolving beyond the meme, definitely check out House of Doge. That's NASDAQ, ticker symbol TBH. They're building the engine that's going to drive Doge utility into the future.
If we just take a look at the stock market, it's in a melt-up mode at the moment. The NASDAQ is in melt-up mode, having broken to the upside from a rising wedge pattern. So putting all of it together, because the metals are only just starting to break out versus the stock markets now, we know that they're at the start of something. And because the stock markets are breaking down versus gold and silver at the moment, we know they're getting close to the end of something. So the fact that gold and silver are breaking upwards from these sorts of patterns shouldn't worry us too much, because we know we're at the start of something for gold and silver. But with the stock market, we're edging towards the end of something. Now, this could go on for a year or two. I don't know. You saw what happened in 1967 there. It took, a surprising amount of time before the stock markets finally rolled over and dropped precipitously. So, this could,
is it feasible that the markets continue to move up nominally, but not in real terms?
Not in real terms, as in priced in gold, do you mean?
Priced in gold or inflation adjusted?
Oh, I see, inflation adjusted. Well, probably not, because melting upwards from a rising wedge pattern implies that the NASDAQ and the S&P are in a phase where they're moving up in quite a rapid fashion. And unless inflation suddenly goes haywire, then these are going to be outperforming inflation. I can just put NASDAQ versus inflation
or relative to gold. Can't it also just be the case that the markets continue to move up because you start seeing everything move up?
Absolutely, and that's quite a likely scenario. If we look at NASDAQ priced in gold, you'll see that it's not looking very good.
Because there's many cases of inflation where, as you know, where the markets move up, but they're moving up in tandem with everything else. But in real terms, that's not the case.
Yes, well, in real terms, I said this, I think, last time I spoke to you, and I want everybody listening to this to remember this. When gold is in a bull era, in a bull market as it is now, price everything in gold, not in dollars.
Mm-hmm.
The dollar is losing purchasing power at a hellish rate at the moment. Gold isn't. Gold is maintaining its it's maintaining its purchasing power, and it's actually massively outperforming inflation at the moment. Gold is massively outperforming CPI and PPI, all measures of inflation, and so is silver. So price stuff in gold. So this is the Nasdaq priced in gold. It peaked 25 years ago in March 2000. I'll just zoom in a little bit. That was when the chart peaked, March 2000. That's when Nasdaq reached its high, and it plunged for 11 years and then began to recover versus gold. But despite the recovery, the Nasdaq never reached those valuations in gold that it was at 25 years ago. And not only that, but we are now breaking down below the long-term moving average. So we've got the 3-year moving average on here, and below the Ichimoku cloud. Now, if you're new to technical analysis and you're like, Ichimoku cloud mumbo jumbo, what's he talking about? When the chart's above this red and green cloud thing, you're in a bull market. When it's below it, it's one of the pieces of evidence to tell you that you're in a bear market. And we were above it. This ratio was above it for many years, so that told us that the Nasdaq was in a bull market against gold. Well, look what's happened now. It's topped and broken down below the moving average, below the Ichimoku cloud. So until the evidence changes, and I've got a perfectly open, unbiased mindset. If this turns up, goes above the cloud and above the 3-year moving average, then I'll be bullish for the Nasdaq versus gold. But at the moment, that's not what's happening, is it? We are breaking down, and we've just broken down for that little rising wedge pattern that I put on the chart there. If I zoom in a little bit, you can see that. This looks bearish to me, until proven otherwise. Nasdaq is in a bearish trend versus gold, and so are all the other stock market indices. I mean, we've got the equal weighted S&P versus gold, which was one of the earlier indicators for us that told us the stock markets were going to be in trouble, and it broke down below the cloud and below the moving average back in late 2024, late last year, so almost a year ago now. So for a year, the equal weighted stock market has been in a deep bear market priced in gold. So it's only those few tech stocks and AI stocks that are holding the stock markets up at the moment. If you strip those out, then the stock markets are in a deep bear market priced in gold. We can look at all of these sort of technical charts that show us that communication services are in a bear market versus gold. We've got consumer discretionary in a bear market versus gold. We've got consumer staples in a deep bear market versus gold. I could go on. I don't want to bore you, but all of these sectors of the stock market are in deep bear markets priced in gold.
But it's not in a bear market priced in gold?
Well, silver maybe.
Yeah. Gold mining stocks, right?
Gold mining stocks, yeah. So they're breaking out. So we can take a quick look at those. And that's one of the clearest charts actually is the HUI index priced in gold. So if we just take a quick look at that.
Mm-hmm.
Let me just where are we? Here we've got gold versus HUI. There you go. So whilst this chart is trending upwards, you are in a bull market for gold versus the gold stocks. So for many years, gold was outperforming the miners. The chart's now broken down below support, below the Ichimoku cloud, and if I could put the 3-year moving average on there we go, below the 3-year moving average. So that tells us that that's a signal. There's a lot of noise on this chart, and technical analysis is about finding a signal.
Mhm.
We had a signal down here when we broke to the upside. That told us that gold was entering a bull market versus the stocks, and it was because we were in a precious metals bear market. So that meant that gold held its value better than the miners. So the ratio went up. Now we're in a bull market. The miners have finally broken out versus the metal, and that's what this ratio chart dropping is telling us. You can look at any of these mining indices. You can look at. We often use the chart for ASA. ASA is the precious metals index that's pretty much identical to GDX, but it's got 50 years of price history. And if I show you those 50 years of price history, you can see over that time period, we built out this rising support line and this rising resistance line. And if I zoom right in, just get rid of that black arrow because you can't see what's going on, and the green one as well, you can see that we've broken out above that red rising resistance line. So the gold and precious metals miners, GDX and SIL and this index ASA, they've all broken out above multi-year, multi-decade resistance lines. So this is the time for the miners. There will be corrections, and there will be nasty corrections in a mining bull phase. You can get corrections of 50%. Go back to 2008 and see what happened to the mining index. Here we go, 2008, it fell 67% and then went on to make the bull market highs. Even, if you don't consider that 67% drop, then, we've got a drop here of 38% that took place in 2002. And we've got an extended period here during 06 and 07 where the miners went nowhere. So, you've got to have a tough, you've got to have a tough stomach to be able to put up with that. But, if you're taking the longer term view, then this is the time for the miners. Expect nasty drops, nasty pullbacks. But if you've got the stomach for it, then this is it.
If you were to deploy capital right now, would you deploy in the miners or some other sector?
If I was starting from scratch right now, and I get asked this a lot, and it frustrates me because I've been telling people to take positions in gold and silver for a number of years now.
Well, let's say you're already positioned in. Let's give it a little twist then. If you were already positioned in mining stocks and commodity in various other commodity stocks, where do you anticipate the greatest opportunity being now? Like if you were to deploy capital right now, provided that you've already deployed it in all the various sectors worth deploying in.
Well, at the moment, the focus needs to be on silver because the gold-silver ratio is dropping, and this is just my personal view. It's not financial advice, but my personal view would be to dollar cost. If you're starting from scratch, to dollar cost average into gold and silver and the miners, but with the full awareness that corrections are going to happen. So if you're to average in over a 12-month period, you would probably see a very significant pullback starting to develop sometime in the next several months. And you'd be able to take advantage of that, assuming you hadn't gone all in one big massive lump, which, isn't really a great idea at the best of times. Certainly when we're getting extended with the price of gold and silver, that's not what I would recommend. So, you can build a position because we're still early. This is still early in the gold and silver bull era, but we have, moved a lot over the last 12 to 18 months. So it's a complex picture of, what's happened, what's coming, your risk tolerance and all that kind of stuff. But having a core position in gold and silver, more sort of biased a little bit towards silver. And then, I personally wouldn't have more than probably 25% deployed in the miners because miners are more volatile, they're more risky. I would avoid micro cap miners that have, market caps of 100 or 200 million, for example, or 50 million. Or at least if I was putting capital into those, it would be, $1,000 here and $1,000 there, a small part of your NAV, whatever your NAV happens to be, and kind of accept the fact that, you know, you might lose that money because the company might cease to exist. You know, I've made mistakes in the past. I've taken positions in mining companies which have got very small market caps, and then all of a sudden the company goes bankrupt, and that's it. You know, sayonara to, you know, whatever cash you put into it. So, you know, those kind of risky explorers and developers, they can make massive gains in this kind of bull era, but I wouldn't focus the bulk of my positions in those. I would have the core position in precious metals, gold and silver, and then have a smaller 20-25% position for the miners. And out of that 20 or 25%, I would tend to focus most of it on the big companies, you know, the Newmonts and the Barricks and, you know, all these multi-billion-dollar companies, and then have maybe a 5% overall NAV position in the smaller companies. So, you know, it's about how you manage your risk. And, you know, I'm not much of a gambler, you know, so I'm quite happy to see my money triple or quadruple. I'm not particularly desperate to see a 50 times gain. I'm not really here for that. I'm here to, you know, grow my capital in a more sort of sustainable and safe way. But, you know, people will do what they want to do at the end of the day, Danny. You can only sort of give.
What about energy stocks? What about are energy stocks relatively a good entry point right now?
Yeah, there are some energy stocks that are looking. I'm going to give a bit of a sneak peek into some trade ideas here, but things like, for example, there are some energy companies. Here's one here, Vedanta Limited. They have a market cap of 1.85 trillion. Okay, they are. If I just scroll down here on TradingView and get the details,
$1 trillion.
Yeah. Trillion. Sorry, this is, I beg your pardon, rupees. Let me put this into dollars for you. This is Indian rupees. Sorry, I beg your pardon. Well spotted.
Yeah, no worries.
Yeah. Let me just, that was a rookie error, wasn't it? There we go, USD. So is it going to give me the market cap in US dollars? Let me scroll back. Interesting, isn't it? It doesn't actually, on the where it has the market cap there, it actually doesn't specify, but it's,
so 1 rupee is like one
you'd have to do
1/100th the US dollar. So
you'd have to do the conversion on that. So assuming it's at least a $500 million dollar market cap, then I'd be quite happy with that. But it's a great chart setup, and you can see the breakout sort of taking place here at the moment with a potential 3-to-1 reward to risk trade, and that's been quite conservative as well. Companies like Athabasca Oil as well, with a very clear sort of breakout developing here, and you know, there's a good trade going on there, 4-to-1 reward to risk. So some of these oil and energy companies are looking very, very interesting. I don't know what the oil and energy companies know that the price of oil doesn't know, because the price of oil has been laboring sort of around the $70 area for a long time now. But I've said before, and I'll say it again, that oil has its bull era when gold and silver has their bull eras. So if we're saying that gold is going to do extremely well over the next 10-year time frame, then I'm afraid my view is that oil is going to move not just north of $200, but probably north of $300 within the next 5 to 10 years. What's going to cause it to happen, I don't know. I know there are lots of fundamental reasons why that can't and won't happen. I'm just telling you what the technical chart tells us. So oil, energy, and some of the other commodities as well, like copper and copper mining stocks are doing great. We're going to start seeing base metals moving. Uranium is still looking brilliant. We've got Cameco in a long-term hold for our website members there. It's been in a long-term hold for a long time now, and has moved up hundreds of percent since sort of 2020 or thereabouts when the signal was given. So uranium sector looks great. And as he quite rightly said, some of these other energy stocks are going to do really well. I suppose AI is the fundamental reason behind all that, because the more AI silly cartoons everybody is crunching, and the more the more daft things people are asking AI to do, the more power we need to do
You've
that.
got to feed the data centers.
Yeah, got to feed the data centers from somewhere, and windmills and solar panels might not cut it. So therefore, oil and nuclear look set to do extremely well, Danny.
All right. Well, brilliant interview as always, Kevin. Anything else that you want to talk about before we wrap up here?
I should mention crypto. Some people watching this might be interested in crypto. The my long-term view for Bitcoin and cryptocurrencies is that at the moment they haven't proven that they can follow gold into a gold bull era. They're still strongly correlated with stock markets. But as I said earlier on, stock markets are doing fine at the moment. They haven't broken down. So there is the opportunity for some selected cryptocurrencies, Bitcoin, Ethereum, Binance, and several others, to do well over the next at least few weeks, if not the next few months. So there's an opportunity there for some of the cryptocurrencies. In fact, Binance is outperforming gold at the moment. So an honourable mention there for cryptocurrencies. But when this all rolls over and we move more, convincingly into the gold bull era, I do think that cryptocurrencies are likely to suffer from a big picture point of view. I think they could well struggle there, Danny. But we'll see. But there's going to be plenty of money to be made in resource stocks and precious metals. That's for sure.
Sounds good. Where do people find you if they want to see more of your work, Kevin?
Well, as always, you can find me at North Star Charts on X, and please be very wary of impersonators and copycat accounts, because I'm getting absolutely plagued by them at the moment, and people are being scammed by them. So at North Star Charts, and you can find the website northstarbadcharts.com. Look out for a Black Friday special offer deal if you want to try us out.
Yeah. I've been playing with a lot of these impersonators as well in the comments section, guys. So just be aware of that as well. I will never solicit you for special offers or deals, or ask you to call me on my WhatsApp number or anything like that. So just be aware of that. Kevin, thank you so much for coming on, my friend. Guys, thank you so much for watching. If you got value out of this podcast, how could you not? So drop us a like and comment "Go Kevin Go" in the comments section. If you agreed or disagreed with anything we said, let me know as well. I do, in fact, read all the comments. And remember to subscribe to the channel so you don't miss an episode. And by liking, subscribing, and commenting, you do support us in getting us boosted in the algorithm, both on the video and on the channel. So it may not seem like much, but if you'd like to support me in a nice and easy way that's free, then a little bit does go a long way. But if you'd like to take it up a notch and support me monetarily and financially, then consider becoming a paid member to my Substack and get access to all of my content for the YouTube audience, ad-free and uncensored for the videos that warrant it, as well as a chance to ask my guest questions to be read on air as well. And finally, check out our good partners in our affiliates section in the description box below. We've got $1,000 off Capital Exploits Insider, 10% off Gerald Salente's Trends Journal, $300 off Uranium Insider. So many great deals and products, and by buying any one of those products, you help support the channel as well. So many ways to support. I greatly appreciate your time, guys, and I will catch you later.